and let's see what FedEx has to offer. Okay, first thing, we can look at this chart here, and I'll bring in a Thinkorswim chart here in a moment, and we can see that the stock has just absolutely been abysmal. Okay, is it all because of Amazon? Is it for this lawsuit they have going? Is their business model just not working anymore? Okay, now, excuse me, I look at this chart, and again, I'm going to bring in a Thinkorswim chart here, but what do you guys see on this stock chart up here that sticks out? Something that sticks out to me like a sore thumb. Well, wait a minute. The 200-day, guys, it's been below the 200-day moving average since September. The blue line is the 200-day moving average. Okay, Michael H. and Mike G., you guys got it. There's absolutely support here around the 150-ish area. And if I bring in now this chart, okay, and really hone in on that area here, you can see. So right here, back in December, kind of at the Christmas crash, and then right here just a few weeks ago. Not only that, but there is some really major volume just above that here. Okay, so there is major support in this stock down around 151 area. I would also say there's some decent resistance. See this gap right here, guys, back in December? This big opening here. Okay. So right here where the stock opened this day, 171. If you look for patterns, that then became support, and then when it broke through, look at that. That area also became resistance. So what that tells you is, from a market technical standpoint, that 170-ish, 171, okay, is a huge area of interest. So when I look at this chart, before we even look at options and what the expected move is and this, that, and the other, I look at this chart and say, lots of support at 150 and some pretty decent resistance at 170. Everybody see that? Okay, so now let's go to our whiteboard. And for Steve, Mike, the new folks that are in here today, do you guys see a whiteboard on your screen now? Okay, great. Stock is 157.75. We just said that there is big support around 150-ish and resistance around 170-ish. Okay, Peter, you're a step ahead. I like that. Peter just said the expected move is about $9. This is going to be a pretty easy one to figure out here because we're sitting right at the strike. So what is the 157.5 straddle trading? Anybody? What's the 157.5 straddle trading? It's trading right around $9. I just slapped you. What is going on? Okay, so it's right around $9. So the market is saying, okay, the expected range right now on earnings is about 148.75 up to 166.75. Okay, Angel, if we look at the market on the at the money straddle, the 157.5 call and put added together, it's about $8.90. So that's why it said it's around $9. In fact, Thinkorswim has it at $8.91. Okay. Now, based on what we saw technically, with the support around 150, the resistance around 170, do we want to be long? Do we want to be short? Do we want to be neutral going into earnings, right? First thing I want to look at is, we know that volatility is expensive, as it should be going into earnings. Okay. Let's see what an iron condor is looking like down to the expected range areas. Okay, so down around 149, up around 167. So let's say we looked at the 150, 148 put spread and the 167.5, 170. I know that's going to be a little high. That's really cheap. That is really, really too cheap to sell an iron condor. Okay, so the 150, 148, and 167.5, 170 iron condor is only trading 85 cents. Way too cheap for us. We want to see about a 1-to-1 reward to risk on a credit spread. And this is way lower than that. It's actually lower than that, Michael, when you factor in that you have a $2 wide spread on the downside, but a $2.50 wide spread on the upside. Okay, everybody following along what we're doing? Okay, so what's another neutral strategy we might be able to look at here to try and take advantage of some pretty expensive volatility in earnings here? What's another thing? There we go. Strangle swap. A strangle swap. Okay, both a calendar put spread and a calendar call spread. Right? If we're unsure of direction, and if we want to stay neutral and are looking for just a move one direction or the other, we would look at a strangle swap. Okay, so if we went right to the strikes we're looking at, so let's say 148 on the downside and 167.5 on the upside. Let's see what vol is doing for next week. We know it's going to be expensive, but how does it compare to this week's vol? Okay, that strangle swap is going to cost about $1.10, $1.15. Okay, so the 148, 167.5 strangle swap is going to cost about $1.15. If I put that on our risk graph here, it ain't going to look too good. Okay? So I certainly don't want to do that. Okay, so Robert, you say a broken wing fly. Broken wing fly is directional. Okay, and I'm not saying that that's not a good strategy here. If we pick a direction, that's good. Okay, however, what direction would we pick? And why would we pick it, most importantly? Guys, can you guys hear me? Okay, so Robert, let's say you want to look at the downside here. Okay, what strikes would you choose? Based on our analysis here, what strikes would you choose? Now, since the beginning of our discussion here, the stock has gone down another $1. So the expected move is going to be the same, but the expected range is going to be a little bit different because the stock has moved. But let's just base everything off of the data that we have here on the whiteboard. Okay, so Robert, if you're looking for a downside broken wing fly, what strikes would you choose based on this data? Okay, Jack, you're looking at an upside, but tell me, Jack, why you would choose 170. Okay, Robert, first off, there are no 156 strikes, but I like what you're thinking there. What is the optimal place for a stock to go on any option position, regardless of your position? What is the optimal place for the stock to go? Oliver, this just shows to the end of the week. This is a weekly thing here. So the data that you see up here is actually June 25th. If you look in the upper left-hand corner now, you can see it says June 25th. Right, to the short strike. So based on what we have on the whiteboard here, Robert, with the expected range, what would be the short strike? 150 is not far off, but what would be the short strike here, ideally? It would be 149, right? The expected range is down to 149, or 148.75. So if I was looking at a downside broken wing fly here, I might look at the 152.5, 149, 148. So it's $3.50 wide, right to the strike that takes us to the expected range on the downside. So the 152.5, 149, 148 broken wing fly right now costs about 80 cents. That's fantastic reward to risk. What is my reward to risk on that? Anybody? If that costs me 80 cents, what's my reward? What's my reward to risk? Well, there's no maybe. There's no maybe here. What is the maximum value? There you go, Glenn. Glenn's got it. What is the maximum that this broken wing put fly could ever trade based on these strikes? Okay, 3.5. Glenn's got it. Everybody else see that? Anybody have questions on that? Right, it's the difference between the strikes. $3.50. So if my investment, if my cost is 80 cents, what's the most I could make on this? Exactly, Robin, $2.70. So my reward to risk is $2.70 reward divided by my 80-cent risk is 3.38 to 1. That is phenomenal reward to risk. Now, again, this is if you like a downside play in FedEx. This is absolutely something that I would do. Phenomenal reward to risk based on what the market is expecting in terms of the quantity of the move. Okay, everybody get that? Everybody understand that? Okay, now let's look at something on the upside. Let's say somebody wanted to do an upside type of play with the exact same type of strategy. What strikes would you choose based on what you see on the board here? Okay. Fred, I got you. Unfortunately, there are no 166 strikes. Here are the strikes that are listed. So we would really target the closest thing to the expected move, the expected range on the upside, which would be the 167.5 strike. With the expected range being up here to almost 167. Okay, everybody see that? Does everybody see that? Here are all the strikes. There are no dollar-wide strikes on the upside like there are on the downside. So 167.5 would be the optimal strike to choose for the center of a broken wing fly, for the short strike. Okay, does everybody get that? No, Robert, the 200-day moving average is up here, around 190-ish. But we're not even taking that into consideration. We are just looking at what strike would be the appropriate short strike based on what the market is pricing in for a move in FedEx on earnings. Literally up to the second data right here, right now. Okay, so if 167.5 was the strike we're looking at, if we wanted to do a broken wing fly, we'd probably look at something like the 162.5, 167.5, 170. And if we did that, that cost about, same thing, 80, 85 cents. However, is the reward to risk the same? Nancy noticed the difference. Nice job, Nancy. Anybody else? Okay, come on. There's over 150 of you out there. Nancy, Jack, that's the only answers I'm getting here? Come on. Anybody else? Okay, there you go. So the reward to risk on this is significantly higher. Okay, it's 415 over 85. Which is 4.88 to 1. Pamela, what are you saying is 3.72 to 1? What is 3.72 to 1? Which reward to risk ratio? Where are you coming up with 338, Pamela? I'm not sure. Okay, got it. So Angel, which one do you want to look at? The put fly or the call fly here to look at the reward to risk? Okay, so what is the maximum value, Angel, of this call fly? What is the maximum value using these strikes here? Okay, Angel, what is the maximum value of that call fly on the board here? It's the difference between the strikes. No. The maximum value is the difference between the strikes. So the difference between the 162.5 and 167.5 is $5. That's the most it could ever be worth. So if I pay 85 cents for that, okay, cool. Pamela, the 170 is just this other strike. For the butterfly. Okay, Fred, I'll do this again. If the maximum value is $5 and we pay 85 cents, then our maximum reward is 5 less 85, which is $4.15. Okay, just like in the put spread, that example that we did here, the put spread example, the maximum value, again, is the difference between the strikes, which is $3.50. If we pay 80 cents, 350 minus 80 gives me 270 reward for my 80-cent risk. Okay, so the question, why wouldn't we do both of these? Number one, you have a crap load full of options, right? If you do both of these, you have a total of 8 options for just one spread, right? 4 on each side. 4 on the call side, 4 on the put side. So your expenses, your commissions are going to be incredibly expensive. Okay, number two. Let's look at the cost of this. If we did both of these, everybody, if we did the broken wing call fly, if we did the broken wing put fly, what would be our total cost? Okay, good. Right, 85 and 80. So if we did both of these, our cost is $1.65. Now, this one's going to be a little bit more to think about. What is our average, and I'm giving you a hint here. What is our average maximum value? Okay, average meaning there's a 50-50 chance it can go down, there's a 50-50 chance it can go up. Love that, Peter. You got it. Everybody know? Okay, Angel, good. Everybody follow that, or wanna see how we get to 4 1/4 as the average potential maximum value? Okay, max value of the put spread, or put fly, I should say, we said was 3.5, right? Max value of the call fly was $5. If there's a 50-50 chance that the stock can move either way, just comes down to simple algebra. Simple math. Okay? Total maximum value of 850 divided by 2 equals an average max value. Whoops, that should be 4 1/4, not 42.5. Okay, so now if we calculate the reward to risk based on these numbers, based on our cost, which is our risk, and based on our average max reward, okay, the reward to risk would be 4 1/4 over 165, which equals, yep, Nancy, you rounded off right there, 2.58 to 1. That is not anywhere near the type of reward to risk that we would want on a broken wing butterfly. And remember, all of the extra commissions that we just generated. Okay? Remember, the goal with any trading, obviously it's to find the most profitable setup, right? I mean, that's a no-brainer. But how often do I also say that term KISS, right? What does KISS stand for? Daniel, you got it. You're allowed to say that stupid word here. Yes. Okay? Keep it simple. Whatever. Okay? Meaning, in the option world, why complicate things? Why do complicated spreads if we don't need to? When I evaluate and I add all of these pieces of this jigsaw puzzle together, it just doesn't add up to take that type of position. Yeah, but Peter, we're taking a quasi-long iron condor here. We're spending way too much. If we could do this and the reward to risk was 4-to-1, 5-to-1 by doing both flies, I'm all in. But for a reward to risk of only 2.5-to-1, no thank you. We will find better opportunities. We will find better ways to use our capital. Well, Angel, you can do that if you believe the stock's going up. Just as you can do that if you believe the stock is going down, you can do the put fly. Okay? Now, my longer term thought process is that I think stock's going up. Whether it goes up on earnings or not, I don't know. So I still want to look at this in something in FedEx is doing something incredibly cheap to the upside, where it's more of a very, very huge reward to risk, minimal investment, high reward type of opportunity on the upside, or something more neutral like an iron condor. Okay, now Angel, you say most likely it will go down. The option market doesn't agree with you. If the option market agreed with you, the puts would be priced much, much more expensively than the calls would. And I'm not saying that the option market thinks the stock is going up. It doesn't. But that's the beauty, guys, of using options. Okay? Is you form an opinion, and we all can have different opinions. And you can form a position based on that, but you always, always can employ a strategy to limit your risk, which is what we do here. Every single signal we send out, whether they wind up being right or wrong, winning, losing, every single signal we send out, we know 100% what our risk is. It is 100% predefined risk. Okay, and that is the goal, is to maximize our profitability and minimize our risk. And that's why we go through this really boring, mundane dissection of a position like this, right? I could just throw a signal out to you guys and say, hey guys, we're going to do this broken wing butterfly, boom. You know, try and get in. But what good is that without breaking it down and actually figuring out, oh, this is why we chose to do this signal, or this is why it's set up like this. That's why we take the time to go through and detail the breakdown of something like this. Now, this one is probably more detailed than we typically get into, but that's okay. You guys are all asking great questions here, which I always encourage because, as you know, somebody asks a question and it leads to someone else asking another question and another question, which is all good for everybody. Exactly right, Todd. It was. So, with all this being said right now, okay, what I want to do is hold off on FedEx right now. I don't want to do anything. What I want to look is I want to see what volatility is going to do during the day. Is an iron condor maybe going to get more expensive? Is there maybe going to be a better opportunity at noon? Because there's nothing glaring right now, nothing just saying, God, we got to get in this. We pass for now, and we'll come back. Okay? Any questions on this? Thanks, Angel. And we will get to Micron next, Angel. Okay, any other questions on this? Otherwise, let me wrap this one up. I'll get the whiteboard posted up in the room here. I'll get the video up here, and we will move on. So let me get this here. All right, that's in the room. I'll get the video up here. Oh, Nancy, see, the light is going on. Day by day, just 1 extra watt in the light bulb shines. And that's what this is. Just little by little by little.